Hello everyone, welcome to EduTap and welcome to the SEBI and IFSCA series of the top 300 MCQs. I hope that you are following this series and you are gaining a lot from this series. So today is the part 5 for the economics where we are going to discuss the top 10 MCQs which are going to check that how much you remember from the topics. Okay, and this is the series for both SEBI and for the IFSCA Grade A examination, and I hope I am clearly audible and visible. Give me a thumbs up. And hello everyone, hello Sarish, Nilesh and Shubham, welcome to the session everyone. So let's start with the session. Let's start with the top 10 MCQs for economics for today, and do subscribe to our YouTube channel. If you have not joined our YouTube channel, you can subscribe to it to continue getting these relevant videos, as well as join our Telegram channel where you will get the PDF of today's session, and the link for the Telegram channel is provided in the description box below. So we have already completed the 4 parts of economics, and today is the last part of the economics sessions. After that your accounts is going to start, so I hope you will enjoy the account session with Santosh sir also. And today we have the economics part 5 where we are going to discuss the last topics that are left, that is the balance of payment and the NBFCs. Okay, so we are going to discuss these topics, and if you have any question, any query regarding any of the topic, you can ask me at the end of the session. Okay, so let's start with today's session without any delay. So which of the following are considered as invisibles in the balance of payment calculation? So try to answer this question. So in the balance of payment, there is the current account, capital account, and the errors and omission. Okay, so mainly the current account, it includes the balance of trade and the balance of invisibles. The capital account, it includes all the assets that are being generated, the liabilities that are there. Okay, the assets that we are investing in outside the country, the assets that are being invested in inside the country from the foreigners, that the foreigners are doing the foreign portfolio investment in our country, foreign direct investment in our country. So this is the current account and the capital account. Current account includes the balance of trade and the balance of invisible. So I'm getting the answer A, and that is really answer A. That is correct. So invisibles, that is invisibles, it shows the trade in services and the transfer payments. These are included in the balance of invisibles. Okay, so balance of trade includes the trade in goods, and the balance of invisibles, it includes the trade in services, and the transfer payments. So tourism, it is a service that is being provided. So yes, tourism is correct, it is a part of invisibles. Factor income, so you are providing the factor services, that land, labor, capital and entrepreneurship. So for your factor services, the factor income that you are getting, it is the income for your services. So this is also included in the invisibles, that is in the trade in services. Income earned from ownership of overseas assets by Indian companies. So the assets and the liabilities are a part of the capital account, but the income that you are earning, from the services that you are providing, for the entrepreneurship that you are providing, so whatever income that you are earning on the regular basis, that is included in the current account. So these all are the part of the invisibles in the current account under the balance of payment. The trade is a part of current account. Okay, that is a part of the balance of trade. So first, second and third is correct. So balance of payment, it includes the current account, which includes the balance of trade, that is the trade in goods, and the current account includes the balance of invisibles or the invisible trade, that includes the trade in services, and the transfer payments. So remember that the transfer payments, the remittances and such, they are included in the invisible account, as well as all the services that you are providing, as well as the income that you are earning, the profits, the dividends, interest. So all the factor incomes that you are earning from providing the factor services, that is also included in the invisible account. So now tell me, the next question is that which of the following comes under the capital account? So I have told you that under the balance of payment, there is the capital account that includes all the assets and all the liabilities. So we are investing in the other countries, the foreign investors are investing in our country. So there is the foreign portfolio investment that is happening in our country. There is foreign direct investment that is happening in our country, as well as Indian investors are doing the foreign portfolio investment in other countries, as well as we are doing the foreign direct investment also in the other countries. SBI branches are present in the other countries, PNB branches are present in other countries. The Tata has many subsidiaries in the other countries. Similarly, the Standard Chartered Bank, that is a bank of UK, they have their subsidiary in our country. So we are investing outside the country, the other countries investors are investing in our country. So this all is included in the capital account. The liabilities, we are taking the loan, we are giving the loan. Okay, so external assistance, that is the government of India is getting the assistance from the other countries, from the multilateral institutions, as well as we also provide the assistance to the other country in the form of aid and soft loans. Okay, non-resident deposit. So non-resident deposit, if the non-residents are doing the deposit in our country, that is a liability for our country, because we will have to return the deposits. So whenever the deposits are happening in the bank, so these deposits are what? They are the liability for the bank, because the bank will have to return this money. So liability and asset, they are included in the capital account. The external commercial borrowings, so that is also a part of liability. If we are taking the borrowings, so that is a liability for us. If we are providing the money, that is an asset for us. So 1, 2 and 4 are included. Transfer including remittances. So remittances is a part of current account and it is not a part of capital account. So 1, 2 and 4 is correct. Everyone has given the right answer. Very good. So the D is the right answer, that is 1, 2 and 4. Next is, which of the following is a part of foreign portfolio investment? So we have discussed about the direct investment. If we are opening the subsidiaries in the other countries, if we are having the controlling interest in a foreign company, or let's say a foreign investor is having a controlling interest in our company, or the foreign investor has opened a subsidiary in our country, so that is direct investment. Portfolio investment is the investment that is happening in the bonds, the shares that are being bought, that are very minor shares, that is not having the controlling interest in the company. So here I am getting the answer C. So that is absolutely correct. Very good. Sorry, no one else is able to give the right answer here. So subsidiaries of a foreign company in India. So if the foreign company is opening the subsidiary in India, so that is foreign direct investment. Companies exclusively financed by the foreign companies, so that is also foreign direct investment. The buying of stocks by domestic companies, so this is not included in the balance of payment, because here we are talking about the domestic company and the stocks are being bought in the domestic area only. So this is not the foreign investment. So foreign sector buying financial assets. So when we are talking about the financial assets, so that is foreign portfolio investment. So only C is the correct answer here. Yes, everyone has given the right answer now. So foreign portfolio investment is the acquisition of the financial assets, the stocks, the minor share that is being bought, minor percentage of the shares, the bonds that is being bought. So this is the financial assets that are being bought. Okay. Which of the following is not a part of capital account? So I hope you will be easily able to tell now that the investment, the assets that are being generated and the liabilities, they are part of the capital account. They are part of the capital account. So that means foreign direct investment, foreign portfolio investment, they are the part of the capital account. The external commercial borrowing, that is a part of capital account. The loans are also the part of the capital account. But the trade of government with other countries, so this will be included in the current account, as the current account includes the trade. Okay, so yes, D is the right answer here. So the capital account includes the investment and the external borrowings and the external assistance. Next is, which transactions are termed as below the line and which transactions are termed as above the line? So here, which transactions are termed as below the line items, that you have to tell me. So try to answer that which transactions are termed as below the line items being determined by the gap in the balance of payments. So here I am getting the answer C, that is absolutely correct. So see, we are doing the transaction, we are importing or we are exporting the good. We are doing the investment or we are having the investment because of the profit motive, because of our self-interest, that we are doing the investment or we are importing the goods for our self-interest, for the profit motive, we can say. So that is the autonomous transactions that are happening. That does not. Autonomous transactions means independent transactions. That does not depend upon the condition of the economy. That does not depend upon that how the country is working. That is just dependent. Autonomous transactions are the independent transactions that are just dependent on the self-interest or profit motive. But accommodating transactions are the one that are the below the line transaction, that if the economy is facing a deficit, that means we have sent more money outside than what we have received. So in this case we have deficit, that we have imported $30 worth of things while the export is only of $20. That means $10 is the deficit that we are facing. So accommodating transactions happen to cover this deficit or to cover the surplus. So accommodating transactions are the ones that are known as the below the line items that try to balance the balance of payment, that the overall balance should be zero. So if there is the deficit that has happened of $10 crores, so that $10 crores will be covered by the RBI through the reserves by providing the $10 crores in the balance of payment. Okay, so accommodating transactions are below the line items that is trying to balance the balance of payment, and these are the transactions that are done from the official reserve. Okay, so reserves are with the Reserve Bank of India. So Reserve Bank of India is using the reserves to cover up the deficit. Let's say surplus is there of 10 crores, $10 crores. So this is going to the reserves. This will be shown by negative 10 crores. So that this is going to the official reserves that is outside the balance of payment. Okay, so that the overall balance comes at zero. So accommodating transactions are below the line transactions that are trying to bring the overall balance at zero. Okay, and if India is facing continuous appreciation of rupees, if the rupees is appreciating against dollars, in this case what will be the step taken by the RBI? So that is rupees is continuously appreciating against dollars. So try to answer this. Okay, I'm getting the answer A. That is absolutely correct. The answer is A, that we are talking about that the rupee is depreciating against dollars. Here the rupee is depreciating against dollars. That means the rupee is becoming stronger. The rupee is becoming stronger against dollars. So the rupee is depreciating against dollars means that dollars is depreciating against rupees. Dollar is depreciating against rupees. Okay, so in this case what is happening, that if the rupees is becoming very strong, that means we have to give less rupees to get $1. We have to give less rupees to get $1. This is leading to the appreciation of rupees. So the RBI will have to buy the dollars so that the demand of dollars increase, and with the increasing demand for dollars, the price of dollars will increase. With the increasing price of dollars, the dollars will start becoming stronger. The value of dollars will start becoming stronger. So here you can understand that rupees is becoming stronger against dollars. That means we have to give less rupees to get $1, and the US citizens have to give more dollars to get 1 rupees. The US citizens have to give more dollars to get 1 rupees. That means our product and our currency is becoming expensive for the US citizens, because the US dollar is depreciating against rupees and rupees is appreciating against dollars. So our products are becoming expensive for the US citizens. So our exports are decreasing when the appreciation is happening. Okay, so when the rupee is becoming stronger against dollars, that means dollars is becoming weaker against rupees. More dollars have to be paid for the rupees, or we can say less rupees has to be paid for dollars. That means if more dollars have to be paid for the rupees, that means the rupee and the products of our country are becoming expensive for the other countries, for the US citizens. So the exports will decrease from our country, and to benefit the exporters, the RBI will have to control this kind of appreciation that is happening. So RBI will buy more dollars because dollars are cheaper, and RBI will buy more dollars so that the demand of dollars increase, the price of dollars increase, and the value of dollars will start increasing, and the appreciation of rupees will reduce. Okay, yes, buying dollars. So now there is an announcement from EduTap that we have brought for you the test series for the phase 2 and for the phase 1 and phase 2. So here you are getting the test for different components, that is the chapter wise test, you are getting the full length test, you are getting the current affairs test, as well as the solved previous year questions you are getting for your complete practice. We can say that you can practice a lot from through these MCQs so that you are prepared to tackle the questions in the examinations. Okay, and there is the flat 55% off that is going on. You can use the code SEBI55, and this is the test series that is provided to you so that you are prepared to handle the kind of questions that are going to come in the examination, and you are practicing more and more questions, so you are getting accustomed to more and more ideas, more and more type of the questions that can come in the examination. So you can enroll now, and this is the off that is going on, so you can take this benefit. Okay, now coming to the next question. So which of the following is or are incorrect regarding the NEER and REER, that you have to tell me. That there is the nominal effective exchange rate and the real effective exchange rate. So which of the following is or are incorrect regarding these? So NEER is the nominal effective exchange rate and the REER is the real effective exchange rate. So the full forms are correct. NEER and REER are determined for each foreign currency separately. No, that is known as nominal exchange rate. Nominal exchange rate is $1 equal to 80 rupees. So that is the nominal exchange rate that is determined for every currency separately. But the nominal effective exchange rate is the weighted average of the different currency values that is determined against our currency. So there is the NEER, that is the nominal effective exchange rate. It is in the form of a single number, that is the index, we can say, that expresses what is happening to the value of the domestic currency against a whole basket of the other currencies. So NEER is not determined for each foreign currency separately, but NEER and REER, they both are in the form of the single number that is expressing that what is happening, what is the value of the domestic currency against the other currencies with which we are trading. Okay, so NEER and REER are the weighted average. That is correct. So only the B statement is incorrect. That's why B is the answer, that we are not calculating NEER and REER separately for each currency. So NEER is an index, the nominal effective exchange rate. It is an index where we are taking the basket of different currencies. So we are trading with US, we are trading with China, we are trading with Russia, we are trading with Japan. So let's say dollars is there, the euro is there, the Japanese yen, the Chinese renminbi or yuan, and pound sterling. So different currencies. So we are trying to see the value of the domestic currency against the basket of different currencies, and the weights are provided to each currency. The weight is provided to each currency. Let's say we are trading the most with the US. So the US currency will be having the highest weightage. We are trading least with the Britain, let's say, so the least weightage will be provided to the pound sterling. So NEER is an index of the weighted average. Weights are provided to the bilateral exchange rates of the home currency against the currencies of the trading partners, and weights derived from their share. Weights are derived on the basis of the trade, how much trade that we are doing with the particular currencies. Okay, so we are seeing that, okay, value of the rupees against dollars, value of rupees against pound sterling, value of rupees against euro and such, and then we are taking the weighted average of the value to see that what is the value of the domestic currency against the basket of the foreign currencies. It is a measure of the value of the domestic currency against a weighted average of several foreign currencies, that is the basket of foreign currencies. So if the value of domestic currency is high, that means our currency is appreciating against the whole basket of the other currencies. If the value of the domestic currency is decreasing, that means our currency is depreciating against the basket of the currencies. Okay, so I hope this is clear, that this is an index that shows that how strong our currency is in comparison to the multiple foreign currencies and the multiple trading partners. REER is the real effective exchange rate. So real means that we are taking it in terms of the real production and such, and the relative movements in the national price we are adjusting the. So REER is nothing else, it is the NEER, that is adjusted for the price movements, so that we can take away the price movements in the national production. Okay, so REER is the NEER. REER, real effective exchange rate, is the NEER that is adjusted by the relative prices or cost, typically captured in inflation differential, so that we can see the actual value of the domestic currency against the basket of the different currencies on the basis of the weightage average, and we can see that how much is the value of the domestic currency when we have taken into account the inflation differential also. Okay, so the REER is the indicator of countries' international competitiveness in terms of foreign exchange market, and if the REER is increasing, just like NEER, if the NEER or REER are increasing, that means our currency is appreciating against the basket of the different currencies. Okay, yes, so if NEER and REER are increasing, that means our currency value is increasing against the basket of different currencies. If they are decreasing, that means value of domestic currency is decreasing against the basket of the different currencies. Indian currency is fully convertible for which of the following purposes? So convertibility of rupees means that we can convert the rupees for dollars, euro, pound sterling and various different currencies. So our currency, Indian currency, is fully convertible for which purposes? Okay, so remember that Indian rupees is fully convertible only for the current account transactions. In the capital account, there are the restrictions. In the capital account, there is the restriction for the foreign direct investment. There is the restriction for the foreign portfolio investment. There is the restriction for the external commercial borrowings. So in capital account, there are the restrictions. That means rupees is not fully convertible for the capital account. But for the current account, the rupees is fully convertible. That means for the current account transactions, the rupee is fully convertible. So for the current account transactions, that means for the trade in goods, for the trade of services, for the transfer payments, for the interest payments, for the income that is being generated, for all of these, the rupees is fully convertible. But for the investment purposes, for the foreign direct investment, for the foreign portfolio investment, for the liabilities and such, the rupees is not fully convertible. Okay, so remember that the rupees is fully convertible for the current account transactions, but rupees is partially convertible for the capital account transactions. In the capital account transactions, there are many of the limitation. So here I am getting the answer A, and that is absolutely correct, that 1, 2 and 4, for the 1, 2 and 4, the Indian currency is fully convertible. For foreign direct investment, the Indian rupee is partially convertible. Okay, so now coming to the next question, that is from the NBFCs. The last two questions are from the NBFCs, so try to answer them. So which of the following statement is or are incorrect regarding the NBFCs, that you have to tell me. Okay, so I am getting the answer C here, absolutely correct. So NBFCs cannot accept demand deposits. The NBFCs can accept the deposit for a time period. Can you tell me the minimum and the maximum of the time period? Can you tell me the minimum and the maximum of the time period? NBFCs do not form the part of the payment and settlement system, because see, in the case of demand deposits, you have the savings account. Okay, you are connecting your UPI with the savings account. Right now you want to purchase a magazine, you are just paying through your account. Right now you want to purchase a mouse, you want to purchase a mobile phone, so you are directly scanning the QR code, purchasing whatever you want to purchase. So that is, these are the demand deposits that is in the savings account, that you can take out whenever you want to create any demand. Whenever you are demanding, you can take this money out. Okay, this demand deposits can be provided to you on your demand. Okay, so demand deposits cannot be accepted by the NBFCs, and so for the payment and settlement system, you cannot use the deposits that you are doing with the NBFCs, because the deposits that you are doing with the NBFCs, they have a maturity period. Yes, for the minimum 12 months, the NBFCs will have to keep your money and for the maximum period of 60 months. Okay, so NBFCs are allowed to accept or renew the public deposits for a minimum period of 12 months and the maximum period of 60 months. And the NBFCs, they cannot accept the demand deposits. That means they cannot accept such deposits that are repayable on demand. Okay, so this both are correct. The NBFCs cannot issue check also, because the check can only be drawn for the savings account or for the demand deposits. The deposit insurance facility of the Deposit Insurance and Credit Guarantee Corporation is not available for the depositors of the NBFCs. That's why NBFCs have to follow a lot of norms when they are taking the deposits, because the deposits that they are taking is not insured by the DICGC. So this is incorrect, because there should be not. So DICGC does not insure the deposits of the NBFCs or the deposits of the depositors that are deposited with the NBFC. So deposit insurance facility is not present for the depositors of NBFCs. Now next question is on the basis of the scale-based regulatory framework of the NBFCs. You must know about that how the NBFCs are divided into the different scales. Okay, so try to answer this question. I'm getting the answer B. Okay, so see, scale-based regulatory framework. So in this, the different NBFCs are divided on the basis of their size, activity, and the risk that they are taking. So on the basis of their size, activity, and risk, the NBFCs are divided into how many layers? The NBFCs are divided into how many layers? They are divided into 4 layers. Okay, so that is the base layer, middle layer, upper layer, and top layer. So for the layer 3, that is for the upper layer, the top 10 eligible NBFCs in terms of their asset size, if they have huge asset size, they shall always reside in the upper layer. So the top 10 eligible NBFCs, they will always have to reside in the upper layer. So the top 10 NBFCs, on the basis of their asset size, they will always be residing in the upper layer. More NBFCs can also reside in the upper layer if the RBI feels so, or if the RBI thinks that okay, these NBFCs are also important and they have more riskiness, so they should also reside in the upper layer and they should also be following the higher norms. Then the RBI can also put another NBFCs in these upper layer, but at least top 10 NBFCs on the basis of their asset size should always be residing in the upper layer and should always be following the higher norms. Okay, so in layer 1, that is the base layer of the scale-based regulatory framework, non-deposit taking NBFCs, they are non-deposit taking NBFCs that are below the size of 1000 crores, they are placed in the base layer and they are following the minimum of the regulations from the RBI. So the top layer of the scale-based regulatory framework, it will always remain empty. It will ideally, not always, it will ideally remain empty, and if the RBI feels that there are some risky NBFCs, the RBI can put the NBFCs in this layer also, but ideally the top layer will remain empty. Okay, so that is the idea, that base layer, middle layer, there are 4 layers of the scale-based regulatory framework. The top layer will remain empty ideally. The upper layer will have top 10 NBFCs. The top 10 eligible NBFCs in terms of their asset size shall always reside in the upper layer irrespective of other factors. So there are the 4 layers based on the size, activity, and perceived riskiness. Base layer is the bottommost layer that is following the least of the regulations because of they are small, they do not have much riskiness and such. Middle layer, then there is the middle layer that takes into account all deposit taking NBFCs that are taking the deposits, so they are more risky because they are interacting with the public and they are taking the money of the public. Then there is the upper layer, that is very big NBFCs that have huge asset size, so they will have to follow the higher norms. And then there is the top layer that will remain ideally empty, but it can get populated on the basis of the opinion of the RBI. So this is the scale-based regulatory framework that we have discussed. Now coming to the homework question. So this is the homework question. Try to answer this question in the comment section, and this is it. Do tell me in the comment section that how much marks you have got out of 10. So this is it for the economics sessions. We have completed the 5 parts of economics, where I tried to cover most of the components that I thought were important or that I thought that you must know about. So I tried to cover them in the 5 parts that we have done. And this is it from my side. And from tomorrow, Santosh sir will be the one that will be continuing this series of top 300 MCQ. So I hope you will enjoy that also. And you are most welcome, everyone. 8.75, you can either get 8 or 9. Okay. So if you have made the mistake, just make it 8. Okay. You are most welcome. Sorish, you are most welcome. Divyansh, you are most welcome. Nilesh, thank you for attending the session. Do tell me in the comment section how much marks you have got. So thank you for attending the session, everyone. You're most welcome, Shubham. So thank you, everyone. I will be closing the session now. Is there anyone that has any query? Anyone that has any query? So no queries? Okay, then I will be closing the session. If anyone has any query, you can ask. You are most welcome, Shubham. You are most welcome, Tech and Games. Okay, do comment down below if you have any query. So you can also comment down below if you have any query. Thank you very much, everyone. You are most welcome, Kamal. Thank you, everyone.